For this video, let's talk about why the S&P 500 may be the greatest investment at all times, even during an economic recession. First, a huge thank you to Martin, who was a viewer from a previous video I did on the S&P 500. His follow-up questions are the basis for this video. Now, in this previous video, I made the argument why the S&P 500 might be the greatest investment ever, based on certain characteristics that define it. As much as I would like to say that that video was a perfect video, unfortunately, it lacked a bit of context, in particular, the current environment that we're in. So with that said, I want to start off by saying that feelings of uncertainty are normal. As an investor, there will be, without a doubt, a time period where you are uncertain if investing is the right decision. It's easy to keep investing when things are going good, but when things go bad, it's hard to see that money leave your bank account. And things will go bad, sooner or later. I mean, look at our current situation and all the things that seem to be going wrong. COVID-19 continues to be a big question mark. There's always the possibility of resurgence and mutations. On a related note, COVID-19 and the government responses have created residual effects in supply chains. Combine that with the economic stimulus and you have the perfect recipe for high inflation. To tame this inflation, the Federal Reserve and other central banks across the globe had to implement an aggressive approach to interest rate hikes. And alongside all of it, we've had a volatile stock market hopping in and out of bear market territory. So many believe that these events are screaming one and one thing only: recession. And to make a long story short, from the perspective of an investor, I'm here to say, who cares? If you're a long-term investor in the S&P 500, none of that should matter, and here's why. In a previous video, I stated that from 1957 to 2021, the S&P 500 returned 11.88% compounded annually. $1,000 invested in 1957 would be worth nearly $1.5 million at the end of 2021. Everything I stated was a fact, but that doesn't mean that investors saw 65 years of consecutive gains. It wasn't all sunshine and rainbows. In fact, investors over that period had to endure some of the most volatile times in U.S. history. Since 1957, there was 10 U.S. recessions, and those recessions consisted of 2 pandemics, the Asian flu of 57 and COVID in 2020. 3 were tied to high inflation and the Fed's eventual higher interest rate response. Another 3 were induced by some form of energy crisis. 1 was the dot-com crash, and of course the 07-08 financial crisis, which was appropriately named the Great Recession. On top of those 10 recessions, we also had 10 bear markets in which the S&P 500 declined 20% or more. We also had 24 additional corrections, meaning the S&P 500 fell 10% or more. But here's the real kicker. Over that same period, we've only had 10 bull markets. That's when the S&P 500 increases 20% or more from the bottom of a bear market. And that begs the question, if we've only had 10 bull markets compared to 24 corrections, 10 bear markets, and 10 recessions, how in the hell has the S&P 500 performed so well? The answer is the recoveries are greater than the falls, and that's why the S&P 500 has been able to return almost 12% compounded annually for over 65 years. The takeaway is to expect declines, expect recessions, be prepared for volatility. But as a consolation, history is on our side. Still, historical performance does not guarantee a positive state of the future, so let's look ahead at a worst-case scenario. Let's assume that recession does fall upon us, and with that recession comes bankruptcies. As it pertains to the S&P 500, I think it's safe to make the assumption that the middle to bottom companies in the index are most susceptible to bankruptcy. In the event that an S&P 500 company goes bankrupt, that company will be delisted and replaced with the next company that meets the qualifications to enter the index. And that's a huge benefit to S&P 500 investors. Yes, it's a short-term setback, but in the long term, that company just gets replaced. As I said before, I think bankruptcy is more likely to happen to the middle and bottom companies in the S&P 500. But what about the top 10? In the event that one of the top 10, say Apple or Google, is threatened with bankruptcy, here's what's most likely to happen. Those large companies are so large that I argue they are too big to fail. And when you're too big to fail, you can almost always count on a government bailout. And if a bailout of big tech seems far-fetched, remember that big banking was bailed out in '08. Think about the global economic impact of allowing one of these companies to fail. Think about the job loss and the negative economic contagion amongst that company's partners and customers. And think about the general sentiment amongst financial markets and investors across the world. And on top of that, think about the financial hold that these large corporations have on governments. This may be pessimistic, but there are monetary incentives in place that make a bailout more likely than a total collapse. So okay, worst case scenario, recession hits and S&P 500 companies are struggling. The companies that do go bankrupt are delisted from the index and replaced with the next runner-up that meets qualifications. But for those bigger names, what's more likely is a government bailout. So for S&P 500 investors, bankruptcies would not be as catastrophic as it's made out to be. In addition to the safeguard of S&P 500 delistment and the likelihood of bailouts, here's another reason why long-term investors should not fear large declines. For long-term investors, large declines equal buying opportunities. When S&P 500 prices are falling, it's important that you view those as discounted prices rather than the S&P 500 declining in value. If today the S&P 500 is trading lower than it was yesterday or even last week, that is just a chance to jump into a great investment at a lower price point. The more historic the decline, the more opportunistic you need to be. And look, I understand, that's easier said than done. Investing while the market is in free fall is terrifying. So, you need to be psychologically prepared to see your investments fall in value. If not, you better have 911 on speed dial because you're going to have a heart attack every time you check your portfolio. Price declines equal buying opportunities, and if you're still not convinced of that, consider this. Wealth inequality worsens after a recession. Now why is that? The wealthy are better positioned to take advantage of the buying opportunities. They know not to run away with the general masses. They stand to make a lot of money during the eventual recovery. Therefore, change the way you look at price declines in the S&P 500, and you'll do well taking advantage of those opportunities. To ensure you're even able to take advantage of opportunities, here are some things you need to consider. First and foremost, you need to be in a financial position to ensure that you can consistently invest. Make sure you have a certain level of job security. A secure job is a secure source of income, which is a secure source of investing capital. Make sure you have an emergency fund. That's anywhere from 3 to 6 months of expenses in the event that something unforeseen happens. And when things start to get a little choppy in the financial markets, it might make sense to have an opportunity fund, which is just a high-yield savings account that has easily accessible cash. This would be money set aside so that you could double down on investments at new discounted prices. If you're financially solid but you can't psychologically handle seeing your portfolio fall in value, then automate the process. Set it and forget it. Many brokerages offer some form of automation that will save you the stress of having to look at your portfolio. So with that, let's do a quick recap. The S&P 500 is still a great investment at all times, yes, even during a recession, because of the following. Historically speaking, the recoveries outweigh the falls. With over 65 years of 10 bear markets and 24 corrections, the S&P 500 still returned 12% compounded annually. Looking to the future, in the event that there's a severe recession that brings bankruptcies, there is a safeguard of S&P 500 delistment and the likelihood of bailouts. And of course, if you're a long-term investor, price declines in the S&P 500 are just buying opportunities. Before you go, here's today's question. What concerns you most about our current economic environment? Does it change the way you think about investing? Let me know in the comments below. And that's all I have for today. As always, thank you for watching. Until next time, take care of yourself and best of luck.